please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to a fresh new edition of Taking Stock, the show where we look back at the week, tell you what was important, tell you what was not important, and of course look ahead for the coming week. We try and answer the important questions which will drive the markets from here on. I'm Prashant Nair. With me is my colleague Rupee. Hi, Rupee.
Hi, Prashant. Well, what a week it's been. Once again, it's like that roller coaster. So first 2 days of this truncated week, 2 days it seemed like the ground is going to crack. And the next 2 days that we had, Wednesday and then Friday, once again, this big rally coming in.
Escape velocity.
Perhaps. I mean, I think it's, so I chose to go with a header, Rupee rumbles, because I think that is what this week has been entirely all about, trying to see what is happening to the currency, why is it falling so much, where will it stop? And then the news, just the hint that the government is going to be looking at all possible measures over the weekend, that was enough to really set the cat among the pigeons, as they say. And then we had that big recovery on the currency, almost hit 73 at one point in the week. And then from there, it pulled back. And with that, we saw the equity market pullback take place as well. Of course, it was only helping that global cues turned benign around the same time. Oil prices at least didn't breach $80 a barrel. They were largely range-bound. And global equity markets were also doing quite all right by the time the week ended. So therefore, we've managed to sort of pull back from the brink, as it were. However, having said that, we've had a fair amount of ups and downs in terms of the themes that were at play. For instance, bond yields going to 8.2%. So that played out quite violently in some of the NBFC stocks. So if you see the intra-week charts, you'll find lots of volatility on stocks like Indiabulls Housing Finance or Bajaj Finance or some of the smaller NBFC names as well. Banks, again, the Nifty bank index is still down for the week. Though, of course, on Friday, the reversal story continued there as well. I'll just quickly talk about the macros, because the good news is that this week we had a flurry of data, largely positive. So the trade deficit numbers for August were looking better. Month on month, there's a small decline that's coming, that's come through. The CPI print was looking very, very good as well, because inflation is very consistently falling below the RBI's projected trend of about 4%. So that was something that obviously the market took note of. So those were some of the cues that we had to contend with. But I guess, Prashant, the big one is really if something is indeed going to be announced or not, and how the market will then, assess the government's own mood on the macros, on the currency and on oil, I'm supposing.
Yeah, absolutely. And I think that is the big question, as we sort of look ahead, which is, can something meaningful come out of the Prime Minister meeting which is being held over the weekend? The only issue with that is most of what can happen with the currency, I mean, at least in the near term, and we're not talking about structural long-term stuff, which is, of course, good and welcome, but we're talking about immediate reprieve. At least the market is looking at immediate reprieve. I mean, that falls under the ambit of the RBI, not the government. So, except saying that, well, we were watching the situation closely, RBI has got lots of ammunition and measures, and RBI will act when it can, and we are going to stick to the fiscal deficit target. One wonders what else can really be announced by the government at this particular point in time. And of course, I mean, this is not news, this is well known, and this is well understood by market participants. So we'll see. I mean, will we see immediate announcement? Or, I mean, after the meeting, we see some unscheduled announcements and comments from the RBI, which prop up the market, followed by action by the RBI, that kind of thing. It isn't as if Monday morning we need lots of action from the government. It could just set the ball rolling for the RBI to come in some shape or form. So that is point number one. What are we watching out for in terms of the big indices, etc.? This resurgence that we saw towards the end of the week, I think the question is still up there, whether what we're seeing is, this global growth theme coming back, or this is just some risk-on that we are seeing for a couple of days. And I'm not just talking about India. You look at emerging market forex, you look at, some of the stock markets which sold off, they started to come back. So that is the question, I guess, will be answered in hindsight, but we are seeing some risk-on at this point in time. The S&P 500 was in a downtrend. That downtrend finished last week. I mean, we highlighted that, technically speaking, it saw a pretty classic, well-formed bullish outside day, and it's resumed its uptrend. So that is US markets for you, and that is the big mother market. So it's headed higher. I mean, at least on the charts, that's what it looks like. US economic data is extremely strong, and markets are still looking back at that big jobs number that we got. So prospects for Fed hikes are still very much on the table. 2 this year, And that means the dollar is not going anywhere. It's not crumbling or anything of that sort. It is expected to remain strong. As far as oil prices are concerned, I don't think anything has changed. It's sort of middling around. No big directional moves are seen. It's somewhere between 70 and 80 odd dollars or so, so it bounces around. Of course, it goes to 70. There are big implications. We're talking about a $10 range, and that's a big range, but that's where it is. The one difference which has happened is that commodities are starting to look like they could bounce from here. And I'm talking about two specifically. There is aluminum and copper. Those are the two commodities which were looking like they were breaking down and weakening. But they are looking like they formed a base, and maybe, just maybe, they start to move up once again from here. So, I mean, that's what we're working with broadly in terms of global cues and the setup that we have at this point in time. So, Rupee.
Okay, well, those are the global cues and the domestic cues. Joining in to discuss all of this with us on the show this week is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, thank you so much for being with us on the show today. So, I mean, my first question to you is going to be on the macros and not the micros, because I think that's the puzzle everybody's trying to get their head around. Should we be worried about this rupee and current account deficit, oil prices, or should we take heart from the fact that the inflation print has been benign? What we got in terms of the August trade numbers, they were looking okay. IIP numbers seem pretty decent as well. Is there any reason to fear and worry about a big correction because of macros?
So it's $1 million question. And clearly today we have bottom-up situation which is looking far better. We saw Nifty results for June 2018 quarter, excluding Tata Motors and SBI. The earning growth is almost 20% and top line growth is 24%. If we look at 3,814 companies which have declared results, the top line growth is about 17%, earnings is about 25%. So there is a broad momentum bottom-up visible in the corporate India, at least the listed corporate India. And again, on the top-down side, inflation at 3.69% is below RBI's target level. Rupee has depreciated by more than 13% year to date. But if we look at on a 5-year basis, it's still one of the strongest currency. Vis-a-vis trade-related, it is still overvalued on a real effective exchange rate. From a current account deficit point of view, yes, if it exceeds 3%, it is into amber zone, but it is not red zone like it was in 2013. And the capital flows have been relatively strong. So clearly it's a kind of a situation where there are factors like inflation, fiscal deficit, which gives you confidence in terms of things are getting stable in India. At the same time, there are factors like oil prices reflected into current account deficit, which gives little bit of, sleepless nights to investors. And you also used a word escape velocity while we were, I was listening to you. In fact, it's quite strange that today US and India are two equity markets which are trading above its 200-day moving average. Whereas most of the other markets like Japan, UK, Germany, Australia, China, they are all trading below their 200-day moving average. This is one of the WhatsApp forward which I have received just now. So it clearly shows that we are trying to escape from the falling emerging market and developed market equity markets to be one of those unique markets in the world like US, which is trading near its all-time high level. And maybe markets are telling that we should not be worried too much with the macro scenario. We should more focus on micro scenario. Maybe market is telling us that.
Nilesh, makes sense. I mean, so you put it all together pretty well. So, for now, immediate in the very near term, would you say the market is, this episode of correction is behind us? We saw about a 4% correction. That is done and dusted with, and we sort of look ahead with the firmer and with some confidence?
No, Prashant, I wouldn't say that, because clearly there are factors which are influencing market, and unless until those variable changes in our favor, it will be difficult to say that markets have made the bottom and there will be no correction. The first factor which we are looking at in the near term is oil prices and its corresponding impact on current account deficit, inflation and fiscal deficit. If oil prices goes towards $60, then I'm reasonably confident that markets have made a bottom. If it's going to go and cross $80 a barrel, then certainly that statement will not be valid. The second thing corresponding to that is US interest rates. Clearly, there has been fairly strong amount of recovery in US economy with GDP growth coming at 4% and unemployment at all-time low level. We have also started seeing average hourly wage rate inching up, and which is generally taken negatively by Fed. So if US interest rate starts moving further up than what is priced by the market, then it will be unfair to say that Indian markets have made a bottom and there won't be any correction. The third factor will be tariff war. Clearly, we have insignificant impact from the tariff for the US and Chinese economy has far more significant impact. But still, as a collateral, we could have some damage from the tariff war unless until we actively go and protect ourselves. So how tariff war shapes up, how Trump levies those $200 billion goods tariff will have an impact on Indian economy and Indian market. And even if we come over the volatility caused by oil, US interest rates and tariff war, then eventually we'll have to face the political situation in May 2019. Market today is pricing in stable government, pro-reform, pro-growth government. As long as that kind of government is received, then hopefully market has kind of made a bottom. But if we don't get that kind of government and we end up getting a khichdi sarkar with no focus on growth or reform, then certainly markets haven't made a bottom.
You mentioned interest rates, Nilesh. That brings me to this one pocket of the market, NBFCs. Now that the cost of money, the 10-year yield, it did touch 8.2%. Are there any specific type of NBFCs that perhaps will get very vulnerable? So therefore, there may be margin compression and maybe some sort of a derating. Is it time to sort of make any changes to the NBFC part of someone's portfolio?
Definitely, one has to now become cautious on NBFC sector unless until they have a good liability franchise, a diversified liability pool, and at the same time they have exercised enough precaution on building a set book. Clearly, money is becoming tighter. 11 out of 21 PSU banks are under PCA. 6 are going towards PCA, so effectively 17 PSU banks are not lending money as freely as they were lending before. Second, the cost of credit is inching up. Money market rates have started moving up. And we have started seeing rating agencies become aggressive on the short-term rating side. And there could be some rating correction in view of what is happening in the money market. So availability of credit as well as cost of credit is going to inch up. And it invariably will have an impact on your asset side as well. So NBFC sector, it's time to be cautious and it's worth going back to the basics. Invest in those NBFCs which have very good liability franchise.
Very good liability franchise. Nilesh, for our viewers, can you identify stocks or pockets where there is significant valuation comfort? Good quality businesses where there is valuation comfort from here.
Prashant, clearly this is a growth market and we haven't corrected as much that valuation comfort starts emerging. Investors will have to pay for the growth. There are some PSUs where value is there, but whether those values will be unlocked or not is a question mark.
Oil PSUs?
And bearing those pockets of PSUs, oil PSUs included and some of the metal PSUs, there is value there, but those values needs to be unlocked. Similarly, there are, exporters where courtesy the currency movement, their business model will receive some amount of boost, and there could be some comfort. I wouldn't call it value, but at least we'll call it as a little bit of cheapness vis-a-vis broad market. But more importantly, if you can invest in companies where in your anticipation the expected profit growth will be higher than what is priced by the market, I think that will be the new definition of value. That's where you will get your margin of safety. This is a broad growth market. You'll have to pay the right price, and you have to invest in those companies where expected growth rate will be higher than what is priced by the market.
In a way, you're saying that you'll have to overpay, but if you can overpay less, that's the trick, right, Nilesh?
Yes.
Okay.
Yes, that's a nice way to put it.
Surabhi.
Speaking of overpaying or underpaying or smartly buying, this argument finally actually hit home on the FMCG and consumer basket, Nilesh. And it was a little, it was a little perplexing for me because there's nothing new. We've known that these stocks are extremely high priced. We know the multiples have been 50, 60, 70 times. So I'm not quite sure what triggered the 10% sort of fall in an HUL. How would you view this basket, and is this fall really the time to buy? Or is this, finally some sort of a valuation topping out of India consumer?
I think there is some amount of temporary cap on the India consumer from a valuation point of view. Today, if we see many of those companies, they are trading above their historical valuation, and their stock market return has been way ahead of their profitability growth. Now, over a period of time, the profitability growth and the stock market return will start converging, and hence it will be fair to say that the consumer-related stocks, especially some of those expensive consumer-related stocks, have probably reached their top in terms of valuation. And unless until we see a dramatic drop in Indian interest rate, which is not visible right now, these valuations will remain as a cap.
Okay, Nilesh, it's a pleasure. Thanks very much for joining us here on this edition of Taking Stock. You have a good weekend, and we'll see you back the coming week. Appreciate you joining in, Nilesh. All right, we slip into a very quick commercial break. We come back and we get you some more market opinion, this time technical. We leave you with some market opinion, though, that we gathered through the course of the week gone by.
What's become very clear to I think fund managers around the world over the last 4 or 5 years is a sort of sobering reality that the Fed controls the liquidity cycle, and whether any of us like it or not, the Fed has a tremendous bearing on stock prices. I did the sort of number crunching last week. I would say something like 55 to 60% of the Nifty's variation, the movement in the Nifty, 55 to 60% is dependent on macro factors around interest rates, around currency, and that in turn is in a way dictated partly by the Fed, partly by the RBI.
The downside for US, European equities could be meaningful. For Asia, equities is generally now getting priced in. And India specifically has outperformed a lot in the context of this outlook, also because of the strong local flows. So fundamental wise, the India long-term story obviously remains intact. So there's no reason to argue that India will necessarily have a bear market over the next 2-3 years. But having said that, the current level of valuations don't leave much room for error or any such risk-based sell-off. We haven't seen any big sell-off or redemptions in emerging market funds yet, despite the pressure points we have seen over the last couple of months.
The amount of fall that you're seeing in the mid and the small caps is more a case of panic setting in retail HNI investors, and we know that the fundamentals are quite supportive of the valuations even at these levels, or maybe even at lower levels. I would tend to believe that if you're slightly longish term investors, these are great levels to buy.
Welcome back. You're watching Taking Stock, a week that's been quite volatile, with everything really now being pinned down on this economic review meeting that the government is going to be holding. We have Rahul Mohinder joining in with a technical perspective on this market. Rahul, thanks for joining in. Now, considering that this week has been really news flow driven, what did you make of the turn of events, and how would you look at positioning for Monday?
So I think definitely the last session was quite dramatic in terms of the move up that we saw. But I think what remains to be seen is, do we get past levels of 10,580, 10,600? That's where I think the resistance is. And you know what kind of reminds me again is, if you look at last Friday, as in the week prior, we again got into a loggerhead at that 10,600 odd level. So it remains to be seen whether this 10,600 resistance is taken out well and we have a more holistic participation, because there's still this underlurking fear that, have we just witnessed a short-term rally or a corrective up move? So when you look at some of the heavyweights, things like an SBI or a Maruti, people are concurring that this could just be short covering, considering we've had a largish kind of drop. So 10,600 odd key level, which I'm going to be watching this week. If we can stay above that and clear this resistance, I think we enter into a new zone altogether. What would I fear on the downside? If we continue to again break down levels like 11,350 odd, again, that will be a key breakdown for me. So we're in quite an interesting point in the market, but again, I would be a little cautious here before turning fully positive.
So, I mean, for the currency as well, if you do track it, do you have a similar slightly skeptical view?
Even on the currency, I think we've kind of at that 70 to 90 top that we've made, that remains to be a short-term high for me. I think it's going to be 70 to 20 odd on the upside resistance for the dollar. I think that's the key level to watch for. But I think the worst is kind of over there. We should see some more strength in the rupee going forward this week.
Okay, well, let's see how that plays out. Back to equities and Rahul, your trading ideas for the coming week.
So pharma was a very interesting sector, and I continue to think we will see follow through within the pharma stocks. And I've been recommending Dr. Reddy, which I'm bullish on. I still see a good 5 or 6% upside on Dr. Reddy. Aurobindo Pharma, another stock which I'm bullish on for 860, 65 kind of targets, keeping a stop loss at 770. So there's a lot in pharma. Even Sun Pharma, if I may add to that list, if you're trying to chase momentum, that's another great one to go with. Biocon, we have a buy call target of 690, stop loss of 637. So fairly bullish within the pharma space. Besides that, I've been mentioning a lot of the metal stocks. So Vedanta would be our top pick there. A lot of volume build up that we see in Vedanta. Immediate targets are 246, but we definitely think if you have a slightly longer term horizon, we could move to levels of 255 to 260. I'd keep a stop loss of 225 when buying into Vedanta.
All right, Rahul, thanks very much. Appreciate you joining in with those trades. Have a good weekend. We, of course, are going to see you next week. Rupee.
Have a good one. We'll be back on Monday morning.